With gold outperforming every other asset class, a rising gold price has not gone unnoticed by fund managers who've never looked at gold investments before, and this massive move into gold has only just begun.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hey, my name is Shane Moran, and I'm thrilled to be your host for this episode, and welcome to Live from the Vault from the entire Live from the Vault team around the globe. You know, we extend our heartfelt thanks for your unwavering support. And as you might imagine, our community keeps expanding week by week, and we thank you. And we couldn't be more excited here. And welcome again to all of our first-time viewers. Welcome to Life in the Vault. Now, we're in the midst of historic times, as you know, and today we've got the one and only Andrew Maguire in the vault, and he's our very own precious metals expert and whistleblower, and he's here, and guess what? He's talking gold. You're not going to want to miss this. So buckle up. This is going to be an incredible episode. And Life in the Vault, you know, brings you weekly exclusive insights and updates that you simply won't find anywhere else. And this episode right here is no exception. But before we dive into Talking Gold with Andrew Maguire, let's just take a moment here to spread the word about our channel. And please hit that like button, not now, but hit it right now. It's easy to do. Just click it, share this information, and don't forget to smash that subscribe button if you haven't already done that. Your support really helps us reach more people with these vital conversations that we're having here at Talking Gold. So with Talking Gold. So now, and if you want to be notified every time an episode goes live, just make sure you hit that black bell there and we'll do just that. So, all right. So hit that like button right now. And without further ado, let's cross over to the UK and some in-depth gold talk with the one and only Andrew Maguire. Hey, Andrew, I can't believe that it's 2 weeks has already passed since our last market update. It seems like it's been such a long time because there's so much going on. And your thoughts were that all the pieces of the puzzle for an end of quarter, 3,000 gold. I remember you said 3,000 gold and everyone said, what? You know, the price finally coming together. But how few people understand that despite gold making still all-time highs after all-time highs is still grossly undervalued. Now, you anticipated a possible pullback, possibility into the end of the month, and it looks like we got just that, exactly what you said. And can you give us maybe your take as we start to show off on where we are now and as we enter the last month of the first quarter here in 2025?
Yeah, great to be with you again, Shane, and great to be with everybody. Yeah, good place to start. Absolutely. Let's pick up the thread, my friend, from where we left off. And, you know, looking at where gold and silver market structures have settled following literally billions of unbacked February gold and silver options and the OCC bets. You remember we talked about the OCC bets, which are the Office of the Comptroller bets. They're listed, they're a quarterly report, and it shows 5 banks with short gold and silver positions or gold and derivative gold and silver positions. And they all had to be marked. Everything had to be marked to a market price, i.e. you pay up or you lose or you win. And that happened ahead of last Thursday's, what we call first notice day, which is where any gold futures positions, OCC bets like that, you know, any that could not be paper settled had to be fully funded and then stood for physical delivery. That is particularly the case in the COMEX. And it became clear that COMEX open interest, i.e. the number of 4% gold-backed gold chips, and they're not gold, of course. They're casino chips but they're backed by kind of 4% gold. And these casino chips are lent out into the market by the casino. But what we've been noticing is that this open interest, well, these chips have been actually contracting, reducing into a rise in the gold price. What that telegraphed was that the official sellers, pit managers, i.e., were capitulating bearish bets against gold into what is a physically driven rally that's got away from them. In fact, even the deliberately stale dated, we only get the odd report, almost nothing from the LBMA, but the COMEX is required to do a weekly report, and it's so stale dated, it's ludicrous. It could be published every day at the end of every day, much like CHOCOM used to do years ago and suddenly stopped for some reason. Why? Because we drew attention to it. But these reports that get published could be, as I say, could be published, could be reported at the end of every day. They're delayed by 3 solid days. So when they come out, it's almost pointless, other than it does provide some footprints. But these reports, these COT reports, as we call them, what they're actually evidencing, and it's impossible to hide, is that into a rising gold price, gold futures contracts are not anywhere close to being historically overbought and continue to look bound for $3,000, which will then become the next higher stair step to $3,500.
As we've been consistently tracking, this is a very, very similar setup to what we witnessed after the Shanghai Futures Exchange launched last March, where futures market top callers had failed to discern that it was Chinese physical market dragon that was wagging the COMEX paper market tail. And we saw a significant rally ensue. Now, this is where it gets interesting, as many technical traders who keep calling gold market tops have not realized that historical dollar and bond market correlations are broken. And this means that all trend lines that were anchored before the Bank of International Settlements revalued gold as a first-tier asset class 2 years ago are consistently mispricing gold futures extrapolations, and these so-called false overbought signals are actually stair-step by stair-step being overcome.
Now, obviously, this strong move into gold has largely been driven by global-facing central bank, sovereign, and institutional physical demand, forcing the market makers with a footprint in both the physical and the paper markets to as well as obviously the cash-settled COMEX paper markets, to race to buy back asymmetrically imbalanced bets, i.e. bets that are not one-to-one backed, they are skewed to the short side. So they're imbalanced. So they're forced to when we see these things happen and the physical market starts to take control, they're forced to cover these imbalanced bets against paper market gold. Now, this represents an unprecedented change in behavior, which rails against the only remaining central bank trying to manage the dollar price of gold, but with the Fed, of course. But with Basel III compliance closing in on US markets on the 1st of July, they're beginning to fold their hand early. Also, with gold outperforming every other asset class, a rising gold price has not gone unnoticed by fund managers who've never looked at gold investments before. And this massive move into gold has only just begun. This opens up an enormous amount of buying that was never there before. So with an increasing percentage of futures market bets increasingly moving into the hands of funds seeking long-term exposure to gold as an alternative first-tier asset, it's forcing bears to fold bets against gold and driving the 50-year unbacked paper to real physical gap to close. So that we've talked for years about how this paper to physical market gap is beginning to close. Now, many funds are not able to hold physical gold, so they buy shares in COMEX-related exchange-traded funds, and they are COMEX-related because it's pretty much dictated by the price the COMEX sets. Now, these bets are seeking exposure to gold. So therefore, they're sticky in nature. They're unable to be rinsed out into synthetically constructed wash and rinse cycles. In fact, quite the opposite. This change in behavior is what we're evidencing here and now. And the physical facing market making insiders, they're aware and they're taking advantage of this bullish structural change in the composition of what is historically unbacked futures markets. Yes, and we'll look at it in a little while on the charts, but as we've seen over the last 2 weeks, yeah, the official orchestrated cartel is still active, all right. And because collusively they hold sufficient futures market position concentration, which is exactly what the evidence that we provided to the CFTC, and it's really about when you have excessive concentration in the hands of a few, then obviously you can control the market. It's what a cartel does. So when they hold sufficient position concentration, they can then identify, and bear in mind they're lending out these chips to people who are borrowing them from, are not paying fully. They're not paying full price for these chips. They're paying just 4% down. So they're able to, having lent these out, they're able to identify and wash and rinse out the speculative, the non-sticky open interest, which is the chips held by the specs who've borrowed these heavily leveraged futures contracts from the cartel. So these wash and rinse cycles are becoming ever more shallow. And it's because the LBMA CME market makers are actually exposed to the exchange for physical mechanism. Remember, we've talked about this. We frequently refer to this as the paper market Achilles heel, because it provides the ability to take a COMEX leveraged position, an unbacked paper position, and to crystallize it into a future, into a foreign exchange contract, which is fully backed. So this enables unbacked futures market positions to exit the 96% leveraged casino and to be converted to foreign exchange market Basel III compliant. That means T+1 deliverable bullion, loco London, forcing their price suppression tactics to change from risky short selling to simply timed bid pulling. And that's what we're seeing. It's a change of behavior. When we see a dip, these commercials are not going short. They're just creating air pockets.
Now, just for reference, I'm recording this on Wednesday the 5th between the AM and the PM fix. In fact, just ahead of the pit oven, and I wanted to catch the ADP print coming through in about 5 minutes, just again to provide a more granular snapshot view of how very short term this collusive bid pulling translates into the creation of downside air pockets, usually at a New York pit open or into the most illiquid times of day. And we see it time and time and time again, often at 2 a.m. in the morning. But what we're trying to do here is illustrate the scope of what can be rinsed out is increasingly shallow, as is evident by the series of impossible to hide higher physically supported stair steps. And for that, we just simply have to move back to, say, the best illustration is the 240 charts, which provide us a good 4-hour view of what's going on. And if you remember, we've been tracking this for quite some time, and we will continue to track it. And these stair steps are also evident in the longer term charts, which kind of gets rid of the intraday chart chatter. So let's look at the current action. So while shorter term officials have managed to rinse out all the fresh, naked long sticky froth, the non-sticky froth. So basically we see a bunch of buyers coming in here. A lot of them are specs who are really just in for the ride, have borrowed chips from the casino, so to speak, to participate in the game, but really are easily rinsable. And we call that the non-sticky froth. As is the case into every single wash and rinse cycle where we regularly see them, we are now evidence fresh open interest additions are related to commercials. Yes, we're talking about the house here, taking the long side of these rinsed out naked long capitulations. And also they've sucked in fresh momentum short sellers, and that we could call that short supply, as these market makers are then forced to hedge a resurgent of fresh waiting official Chinese demand, really not seen since the Shanghai Futures Exchange launched 1 year ago, March, 1 year ago. And that drove, if you remember, an over $800 rally. And then obviously we saw a bit of a pullback into the end of the year, but still finishing well over $600 higher. So into last Friday's bid pulled event, and that occurred into where first notice. Now, first notice is when the March contract, which was about to expire, basically March contract expires at the end of February, and that basically enabled, and this is traditionally a time when we know there's a lot of speculators who literally they're still in these positions, but they have no intention of taking delivery. And first notice means you have to fully pay them up. So pull some bids, and then basically you can then create a big gap, an air pocket, so to speak. And what this did was actually drove, we evidenced a huge resurgence of Chinese demand driven by the fresh Chinese tariffs, or Trump's fresh tariffs. And it drove very large gold demand into the overshoot of central bank bids at 28.50 last Friday. And then that's, because this is a futures chart, 28.50 equated to 28.56. Now, directly after, following the Chinese gold buying into the first PM fix sub 28.50 since the 4th of February, and that so basically into an expanding EFP spread, so to speak. So we had the futures spread widening, and we had the spot price surging. Commercials were forced to rally spot gold back up quickly because you've got the central bank buyers coming in here. Huge central bank bids getting triggered here, and then they had to start short covering in a hurry. Now, the 38 sequential fixes above spot 28.50 had already cemented this higher central bank support level. And the fix below this level forced commercials, as I say, exposed to these upcoming T+1 delivery obligations to take the long side of every single synthetic sell order. And they did. Also, Indian FX gold buyers were all over the Friday discount into the PM fix, which was here. While India official gold reserves assets are 74.57 billion, this, albeit large gold interest, represents only a tiny fraction of the gold held and being accumulated by industry and the population. Just for the record, we just had ADP come in with a miss, an upside revision, usual bit of volatility around that, but we're waiting for the pit open as well. Now, bearing in mind, this was the last day to deliver on the February contract. There was a 238 tons delivered into this last day of this contract. And this jives with the premiums, and that was an $11 premium. And that jives with the premiums, the two buyers we drew an attention to in our last episode, who we knew personally was standing for delivery of their full lots. Now, they're obviously restricted to 6,000 lots apiece, which these two 18.66 ton loadouts and the EFP outflows were respectively headed into Saudi and Indian hands. And we also hear the bulk of the remaining 200 of the COMEX deliveries related to actually New York dealer buying. They had to buy back February gold to short cover asymmetric COMEX shorts, i.e. asymmetric in the sense that they weren't one-to-one hedged, they were actually biased naked short. Just for the reference also, into the March gold contracts first notice, these same two clients stood for delivery, locking in EFP premium over spot of $9.90 per ounce. So as expected, as we can see this week, and this is where we are this week, the very large reported Chinese buying spooked commercials, forcing short covering into these low-hanging momentum shorts. So in other words, as people had gone short, momentums had gone short, their stops were easily attractive and were rinsed out to the upside. And it was no coincidence to see, this is where what we saw was an expected gap close. And sure enough, we saw this gap close into where the first notice selling was, 29.3580. We breached that. Then we saw the pit open yesterday selling, but they still failed to close gold below 2,900. So since the 10th of February, despite multiple attempts to synthetically cap gold into another end of month options rinse, which is what we just witnessed here, and that, again, a rinse of speculator froth, spot gold is now fixed above 2,900 25 times out of 33 fixes, and that includes this morning's AM fix. And what that does is increasingly evidence that the underlying physical market dog is wagging the paper market tail. Also, attempting to cap silver at 32, which 32 is the 32 spot level because of the premium is roughly 32.57. So attempting to cap it into strong demand, into a very strong for demand undersupplied global market is going to become far too difficult. So what we're saying is it's becoming increasingly difficult for COMEX-centric synthetic capping to continue to short cover these efforts to accommodate and also attempting to cap spot silver at 32, and the spot 32 level is actually in the futures contract. The May futures contract is 32.57 in round numbers. Attempting to cap that it really into a strong demand undersupplied global market is going to become too difficult. It's becoming increasingly difficult for COMEX-centric synthetic capping to continue into commercial short covering efforts to accommodate New York dealers taking physical delivery to cover COMEX shorts alongside large backdoor loadouts, reducing rinsable spec open interest, i.e. the specs that can be rinsed. So basically, in summary, while geopolitical and tariff uncertainty has been assistive in driving safe haven flows into gold, it was Thursday's first notice bid pulling that resulted in Friday's overshoot of these very, very large central bank sovereign and institutional bids at spot 28.50 that also forced commercials exposed to the resulting T-plus delivery obligations to hedge these delivery obligations. So basically, all the medium-term and long-term gold charts remain extremely bullish.
All right. Now, Andrew, you mentioned that you personally knew of some COMEX buyers that were happy to pay a large EFP premium to secure the immediately deliverable gold, but also that several were holding maximum allowable amounts of chips to cash in for otherwise impossible to obtain bullion at these current prices. Can you talk about that?
Yeah, Shane, and as we've just looked at, when we drill down into the action, this becomes increasingly evident. Now, at Tuesday's options and Thursday's first notice speculator CTA long rinse, as that fully played out during the Friday liquid session, we noted strong global-facing physical buying was rewarding central bank, sovereign, and insider buyers who've learned to alchemize these end-of-month derivative squaring events, happy to pay a substantial premium over the spot price to obtain immediately deliverable bullion into global shortages. So it's difficult to get the spot price at these prices. So where do? We come to the COMEX and say, give it to me. Now, for example, into very real global supply shortages, that's for immediate deliverable bullion. You don't want to go on a list saying, yeah, I'm owed it and I'll get it down the road. You want your bullion immediately so that you can use it as a first-year asset. So what we saw was, and this is drilling down a bit, it gives us visibility. The last 1.47 tons of the February gold futures had to be loaded out last Thursday. It was the last day the seller had to fulfill his delivery obligations. Why he hadn't settled them at the beginning of February rather than at the end of February simply meant that they simply didn't want to provide it. Otherwise, you would just remove that friction. If you were one-to-one hedged, you would discharge that liability and move on. So, yeah, but what did they pay? And obviously they paid what they were forced to do was pay a $38 premium over spot. Now, that, when you think about it, that's 1.7 tons. And that's a $1.88 million cost to square this dragged out delivery obligation. Given no bullion banks are allowed to be naked short gold, it had to sit on the Fed's books. It is as simple as that. There isn't a single compliance, too big to fail bank, bullion bank or bank compliance office that would allow a naked short position to be held by the banks. Now look at the full month. If we look at the full month of February, COMEX deliveries and the premium footprints, all the clues that the banks are viewing gold as underpriced were evidenced into their short covering footprints into a month-long sequence of collusively bid-pulled air pockets. Into each bid-pulled rinse, insiders have short covered. This consolidative froth rinsing, it's constructive as it removes sufficient non-sticky CTA, long open interest, for them to be able to rig a larger gap close below where we see rising central bank support levels. Now, as is always the case, into paper-driven wash and rinse cycles, under the COMEX-driven chart chatter, the clues that the insiders are going long are all there. Now, given these delivery obligations confluenced with the largest central bank T+1 buying since the Fed squared underwater Bank of International short bets on the 31st of January, and note that was the end of the month options and first notice timing yet again. Our two clients standing for delivery of higher priced COMEX EFP premiums over spot were not alone.
Now, given these delivery obligations confluenced with the largest central bank T+1 buying since where the Fed squared underwater BIS short bets on the 31st of January, and note the end of the month options and first notice timing yet again, our two clients standing for delivery of higher priced COMEX EFP premiums over spot were not alone.
Now, while these COMEX footprints provide us some visibility into the scramble by commercials representing really wrong-footed officials, providing them opportunities to short cover some of their naked short bets, the real action is evident in the 10 times larger net stable funding requirement compliant FX gold markets, populated by the very large central bank, sovereign, and institutional buyers. They know this game, they know end of month gaming, and they wait and get rewarded consistently. And while this strong T+1 demand into global shortages occurs outside the COMEX bubble, where most traders trading in the COMEX have no visibility, it's a dot on a screen, it is paper backed, it is not physical. So it happens outside of their bubble and completely flies over the head of the wrong, at both end, CTAs and momentum actors. Commercials exposed to the real supply demand physical markets are busy short covering into a visible, physically determined range. Now, the COT short covering footprints are getting much, much harder to hide. Now, bear in mind that open interest has contracted from around 550,000 contracts at the beginning of February trading. It fell to 524. As we moved higher into the 20th of the February 29.7450 highs, and has now contracted by another 34,000 lots, it provides clear evidence that the bullion banks are not just going one-to-one long against rinsed out speculators, they're also buying gold to meet physical delivery obligations. Gold is nowhere near historical overbought 600,000 level, 600,000 open interest levels. So in other words, where open interest has been expanded to that level, that is usually a marker to say it's so much froth in there, it's going to get rinsed. And it's currently well inside its neutral zone. It's an incredible amount of upside potential. And as we're trying to draw attention to, none of the data captures China aggressively coming back into the mix last Friday. Furthermore, since Basel III revalued FX gold as a first-tier asset class, the open interest levels are reflecting an increasing number of these CTAs seeking really long-term ETF and COMEX exposure to gold. Even though some of that's leveraged, it's representing an alternative first-tier asset class. So really, and this is an increasing component of the COMEX long open interest that is sticky. It's not able to be rinsed out along with historically targeted speculator froth. This increasingly physical backed open interest process will continue to evolve into the 1st of July COMEX Basel III compliance. That is when Basel III compliance hits New York.
All right, Andrew. Now, we've had a lot of questions from the Live from the Vault community. You're going to think this is a Shane Moran question here, Andy, but here's what it's about. It's about silver's underperformance versus gold. Yet I know that you see silver on the cusp of a large breakout. Can you share what you're seeing here with our viewers?
Yeah, absolutely. I know I must get more calls about silver than anything else. Picking up the thread then from our last episode, we recorded that on the 19th of February, where we'd evidenced spot silver being capped at $33, which was a full $2 above where the cartel mark to market for their derivative. It was $2 above their derivative bets. So they really wanted it back down. They needed it back at $31, which was their derivative market, the options market sweet spot. It was no coincidence that these wrong-footed actors, and I'm talking about wrong-footed to the tune of $10,000 per contract. Each contract's worth $5,000. So they were $2 offside. So $10,000 offside. So they threw the kitchen sink at silver to protect these bearish bets from being crystallized into massive losses last Tuesday, which was when the options markets get mark to market. Now, if you want to give an idea of scale, into the March options expiry event, which was the end of February, silver still had over 41,000 contracts open, in other words, it had 6,400 tons of paper silver, unbacked paper silver, sitting there, and the price was $32.60. That was $1.60 above the sweet spot still. So that was $8,000 per contract underwater. And let's just call that a cool 330 million in the hole. And while they had managed to rinse out the speculator aspect of that, because bear in mind, there's some people targeting this for delivery, they'd rinsed out 26,000 speculators into first notice last Thursday. In other words, because while the speculators can hold silver long, and they hadn't yet been rinsed out, this is the moment last Thursday, what we call first notice, where all the remaining lots have to be fully paid. In other words, it goes into the hands of professionals. No retail speculator is ever going to fully fund a contract. They're just gaming the movement in silver. So what that did, it meant that after all was said and done, they still had an underwater exposure of 63 million. Now, 63 million is not small potatoes. So bearing in mind, these bearish bets extend all the way into the billions of dollars of offsize over-the-counter bets identified in the Office of the Comptroller report. Now, while the OCC report identifies the 5 banks on the hook for these bets, all of these banks, without exception, are long silver for their own books. And these long-standing cartel bets against silver are in official hands. And you know that officials have been managing the price of gold against the dollar, and they know silver is a component of that. So it doesn't take an awful lot of volume to move silver. So often they will lead a sell-off with pulling some bids on silver. Now, these long-standing cartel bets against silver are definitely in the official hands, and they're going to have to get bought back. Silver is coiling for a very large catch-up rally. And while blinkered speculators who have no visibility into the tight for supply physical markets have once more allowed themselves to be rinsed out of these casino chips borrowed from the cartel, more fool them. And on the other side of this action, this counterintuitive synthetic rinse lower, every single physical facing first-tier liquidity bank acting for Chinese, Saudi, Indian buyers have been taking the long side of every tricked out speculator long. Now, bottom line, this paper market wash and rinse cycle into the 31 level rinsed out all the easily accessible bullish bets, so they couldn't take it any lower. Also, it's impossible to hide that Indian and Chinese silver buying was tripped off into the COMEX-driven breach of spot 31, the spot 31 round number, which is the May futures equivalent is 31.52. Now, while silver prices have been lagging gold, the lack of availability to secure immediate local London delivery at current COMEX diluted FX prices tells us physical silver is severely mispriced. In fact, because refiners continue to defer large size orders for kilobar silver so as to focus more on refining more profitable gold orders, shortages are even more pronounced than gold. Now, what this means, and is, yes, it's there if you want to pay a hell of a lot higher price. But if you want to pay a spot price for silver, you're going to be limited to what you can get. And what this means is that buyers looking to secure otherwise unavailable underpriced silver bullion are surgically targeting COMEX 1,000 ounce standard bars to their maximum 3,000 lot, 465 ton position limits for loadout. And that is taking delivery, not washing it into just moving it across the warehouse blue line from one side to the other as a delivery. No, at the back door back open, loaded out. Yeah, there is some element of that that moves into the dealer's hands, because they know they have to start short covering. So they will move it from a registered to an eligible, and an eligible position cannot be traded. So essentially, they're trying to back their short positions as quickly as possible. Now, the unprecedented exchange for physical spreads between spot silver, we've been looking at them over the last few weeks. I mean, this difference between spot silver and the futures markets, they're only large enough to pay for air shipping out of local London, 1,000-ounce supply, to New York to cover largely a massive COT, largely swap dealer, short positions. What that's doing is further tightening available global facing supply at current foreign exchange silver prices. This is a really tight situation. It's evolving into a coiled beach ball rally. Now, we've evidenced the largest COMEX physical delivery since the Hunt brothers debacle. Only this time, the bullion that's being loaded out of the COMEX is fully paid up and headed to Asian-facing exchanges, where immediately deliverable physical bars are being priced significantly higher. During the Hunt brothers period, what they did was simply the bullion was still within the COMEX ecosystem. So what they simply did was say, no, you can't buy it anymore. You can only sell it. Well, clearly what happened. So everyone's aware of that game. And really now, by taking the physical out of that ecostructure, you cannot do that. And we're also evidencing large Asian spot silver foreign exchange buying as well. Now, even though foreign exchange silver is not NSFR Basel III compliant and therefore will eventually be delivered, it remains for the short term as a paper claim obligation on the seller. But once an FX silver price is locked in for $1 price, and that's currently below the current local London critical float threshold capacity to deliver, hence it's not being delivered. And given that the LBMA cartel are refusing to supply any size at current prices, it drives buyers to source silver directly from producers and refiners outside the LBMA ring fence at a premium. This is where the real globally determined supply-demand price is discovered. That means where a seller, a physical seller, is willing to offer immediately deliverable silver bullion for sale in whatever size that he is prepared to do that for. Now, given the LBMA CME cartel are still trying to hang on to the last vestiges of a 75-year centrally controlled COMEX silver cartel price that is from 1933 to now where we are in 2025, an increasingly decentralized physical silver market has become liquid enough to prey on this fast-closing FX market arbitrage opportunity. As this decentralized process gains momentum, where a physical bar has to be fully paid for before it can be offered, this further tightens local London CME supply, but more importantly, it establishes a real physical silver supply-demand price. So it's not unusual for this to translate to plus or minus 10% premiums over spot in Shanghai. Supply shortages at current FX prices is why we've also evidenced up to $1.35 spreads to short cover naked short COMEX positions. Now, the front month most liquid May contract is still commanding a $60 premium over spot, which is far larger than it should be. So in summary, the London physical trade is no longer recognized as the globally centralized physical trading hub that it was before Basel III NSFR compliance enabled decentralized T+1 deliverable gold FX orders to directly flow into physically settled BRICS central global exchanges. Now, this decentralized effect has also majorly impacted the silver trade, driving the ratio trade to an unsustainable breakpoint. And we've even got Bloomberg now out raising the odds of silver moving higher and making the statement, keep an eye on silver as it starts to pick up versus gold. Hardly an incentive to double down on any silver price suppression.
All right, Andrew, at the start of 2025, a couple months ago, gold was priced in at about 26.30, and based on central bank, sovereign, and also institutional demand, that you had gone out on a limb, I remember at that time, to say that we would see, I think you were the first to say, a physical supported $3,000 gold price by the end of the first quarter. And it looks like we've come very, very close to that. So do you see this still as playing out here as we're in the beginning of March now?
Absolutely. We've got 3 and a bit weeks to go. Yeah, Shane, while resistance at 3,000 is clearly apparent, hence the race by officials to cap rises into it, and we've looked at that. What we're seeing is these efforts are becoming increasingly difficult due to what we're just discussing earlier, which is the long open interest, the chips that float around the casino now populating the COMEX and the COMEX and the exchange for and the ETFs. These are longs that are seeking that exposure to longer term exposure to gold as this first year asset class. And as we say, sticky and hard to rinse. That changes the game. And this enables them not to get the traction that they need to be able to maintain this scam. This will expose blinkered bid pulling and momentum-induced selling to be quickly capitalized on. And we are seeing that. Okay, it was 31 this time. This should be 33 as a pullback point. And it should be obviously on the way up to 50 plus, but obviously one step at a time. Now, from a macro perspective, central bank sovereign physical gold buying is increasingly being sourced directly from producers and refiners, with the bulk of fiat FX gold and fiat FX silver to be into physical, of conversion into physical. That is actually flowing into the BRICS facing exchanges. It's gone. You're not coming back. Notwithstanding that central bank sovereign monetary gold purchases don't require reporting, an increasing percentage of these flows are settled outside the SWIFT messaging protocol. We looked at that last time. In fact, to escape sanctions and freshly instigated tariffs, a large barter trade is actually evolving. And of course, there is no better fungible barter benchmark than gold. And we reliably hear that Russia supplied gold to China in January by way of barter.
Notably, into a $258.90 rally from the 20th of February's, 20th of January's 27.15.60 print, into the 20th of February all-time high print at 29.74.50. Now, and of course, we'd circled this blue, this rally point blue, and said we will obviously continue to track this in every episode. Into this move, open interest, or the number of chips in play, had contracted by a significant 60,000 lots, illustrating a race by officials to short cover the naked short element of their asymmetrically imbalanced COMEX gold positions being increasingly targeted for delivery. Now, this short covering illustrates commercials are using every bid pull trick in the book to short cover. And while this partly relates to a race to bring bullion to New York to cover short positions, we're also evidencing very large EFP outflows to meet T+1 physical demand, which is not just coming from impossible to hide Asian-facing physical demand, but also an increasing percentage of COMEX open interest and ETF inflows relate to a large inflow of sticky, fresh institutional buyers seeking to obtain long-term exposure to gold. And while the daily pit open tricks to short cover, and here we are at the pit open today, which we wanted to capture here. So we're seeing some pit selling at the open, which is of course par for the course. And while this tricks in fresh short sellers looking to game the bid-pulled vacuum, it also incentivizes sticky COMEX ETF and central bank dip buying, with commercials short covering these synthetically derived daily discounts. That's really all we're illustrating in this chart. So a quick look before we close the charts off at the daily in spot gold and the daily in spot silver, all looking bullish under the very short-term chart chatter.
And just as BRICS settlement platforms are being forgotten about, remember we talked a lot about them and there was a lot of toing and froing, tariffs have really sparked fresh interest in this. Russian Foreign Minister Sergei Lavrov, he recently reaffirmed, and as he put it, BRICS nations continue to discuss implementing payment platforms alternative to American ones for members of the alliance. Well, that is inevitable. And the more that tariffs get rolled out, the more it impacts. And obviously, we don't know how that's going to go. And maybe this is just Trump just being strong in getting good deals. But I mean, tariffs are essentially can be interpreted as sanctions. And we've already seen Europe talking about seizing the Russian assets and one thing and another. It just isn't very helpful for the payment system. Now, so with every single liquidity provider and almost all bullion banks anticipating it's going to cost far more dollars, pounds, euros, and yens, etc., to buy the same ounce of physical gold and silver, there's only one question remaining. How well are you positioned to protect your wealth?
All right. Thank you, Andrew Maguire, for another fantastic episode. And remember, to our Live from the Vault community, buy physical and understand the critical difference between what Andrew calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same, so don't be fooled. All right, there you have it, folks. That's all we have for you today on another episode of Live from the Vault. And please keep help spreading the word about this channel by hitting that like button. If you haven't already hit the like button, go ahead and hit that like button right now. It really helps get this information out to more and more people. Share this information and make sure you're subscribed. And don't forget to click on that bell if you want to be notified as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. We'll see you then.